Welcome to jimsnotes.com. I'm Jim Farish, editor and founder of Jim's Notes. Tonight I wanted to take an opportunity to continue in the vein of education, which each Monday I'm trying to put out some educational material for you to follow, learn, but doing it in vein of the markets real time. Obviously, if you're listening to this later in time, then it's going to be historical. But if we're looking at it currently, it takes the markets real time and kind of gives you ideas of things as they develop and opportunities that you can use going forward using whether it's technical analysis or fundamentals or scanning or any variable combination thereof, but just kind of giving you some ideas as we go through markets on a day-to-day basis of things that we see, use, and trade on a day-to-day basis that have worked for us historically over the 30 years plus that we've been doing this. But obviously, the key is you have to learn first and foremost, and then you have to test and experiment and practice until it becomes natural for you within a trading environment to do that. So what I wanted to talk about tonight are what I tend to call mini reversals. And all we're looking at here is where the market tends to get ahead of itself. Some people call it buying on the dip. I tend to dislike that terminology in that sometimes you're a dip for buying the dip. But in many reversals, what you have is some event news in the marketplace that is causing worry relative to valuations, and that causes prices to retract within a reasonable or orderly format. And if it's a news-driven event, it will happen faster than if it's just a fundamental valuation where things tend to get a little bit pricey. And we'll look at a couple of examples tonight of things that are happening right now and that have happened over the last few days that have set up very nicely for a couple of opportunities. But more importantly, it's how do you see these opportunities as you go forward. And I think that there's a couple of variables in there that you want to pay attention to, and that is what's driving the movement of the market. And that's something that we talk about on a regular basis, so it's not new for me to talk about the markets moving. But let's just pull up the S&P 500 as an example, and you can see inside of this trading range that we've actually have established right in this format here, and then you've got a little bit of an upward trek inside of there. But we have a trading range that the market has found a way to establish itself within, and each of these pullbacks or tests within this is all part of and parcel to the overall trend, which is still on the upside. And that's where my opinion that many times we get distracted by the short term versus what's happening in the market longer term. And that is that the trend, as we look at this in May of 2015, that the trend really has been on the upside. It hasn't really changed in any way, shape, or form. But what has changed is a consolidation. And this isn't the first time that we've seen this in the market. You can see that we had a period right in here where we got that, and then we broke to the upside. That did not turn into an elongated uptrend. It actually turned into the next trading range that we're experiencing right here, right now. And even if we wanted to adjust this a little bit, if we brought this back into this format, we actually have another kind of a mini range that had set up right in here, which has a shorter base or support. But each of these have evolved into either breakouts or failed breakouts, but they give opportunities for you to trade within the environment that the market's given you. In this example is a trading range. So that's one type of setup that you would have. The other would be to look at the Russell 2000 index, and if you can see in this that we had this trend that was going up, but we broke the trend. This was off the October lows, so that was a short-term trend line. We take that trend out on the downside. We actually take out the 50-day moving average and some other key support levels, but we find support back at around the 1210-ish level, and then that bounces, and you can see some movement back to the upside off of that, or a mini reversal off of that pullback break of the trend line. But all of that comes on the heel of the fact that the longer-term trend line, which you can see is still intact on the upside. Matter of fact, if we convert this to a weekly chart, you can see it a lot clearer, and that we have a very distinct uptrend line for the index. And even converting this to a monthly chart, you can see going back to the 09 period that uptrend is still very much in play from a longer-term perspective. So sometimes you have to back away, look at what the major trend is, and if that major trend is still intact, then you want to look at these pullbacks or test as an opportunity. And then in October, obviously we had a very big test pullback of about 9 to 10%, which some people will state as a correction, but that gives you an obvious bottom reversal that you would want to look at just as much for the opportunity that resides within the bigger corrections and or tests or pullbacks, whichever phraseology you choose to use. But anytime the market sells off, whether it's 1% to 10% or 20%, anytime the market sells off, that's where I would start looking for a actual reversal, whether it's a mini reversal because it was a mini pullback, or whether it's a major reversal off of a correction type situation. Either way, the market sets up and it gives you an opportunity to trade off of that. So let's put both of these in play, and we're going to look at a couple things and what's happened of late. And if we look at the S&P 500 example here, then what we want to first look at is the fact that we've got these little downward trajectories in the market. Now, this has been a very choppy market. These are much easier to transcribe and look at. These, if you look at this couple week pullback and test there, this is about a 1 week test. These are 1 week, but they're much sharper and much shorter in duration, as you can see by the setups of both of these. These were deeper, more methodical. These are shorter and more herky-jerky, if you will. But either way, they're still setting up opportunities by the fact that we sold within each of those pullbacks and or tests of the major trend, and now it sets up to break out. Now, because these are short and choppy, then you are going to be less inclined to want to buy on either this bar or this bar, this bar or this bar. But if you look at how it sets up and it breaks out to a new high, if we pull this line across there, and you've got a pattern set up as well as a pullback test. So you've got two things going on in that you have an ascending triangle looking to break higher, and you're looking for volume, which you did get off of this 2-bar move. And then today, being May the 18th, you get a confirmation of that move to the high with an entry point there around the 21-23-ish mark on the day. So now you have a trade that you can put on in the S&P 500. And obviously, since we can't trade the index, we need to use an ETF. We can use SPY. And if we pull this bar up right in here, you would see that the entry would be roughly around the 211, 212-ish mark. So you got an entry off of Friday's bar. You could take the entry a little bit higher today with a confirmation at around 212.40 on the entry. So either bar works for adding that position. Depends on if you trust buying into a Friday with the weekend inside of a choppy market and prefer to come into Monday and take the trade on Monday. Or so either or, the setups were there for either day relative to the transaction to buy SPY. If you want to leverage it, you can use SPXL, which is 3 times leverage, which you can see for the directions fund, or you can use SDS, or you could use SSO, which is the 2 times leverage ProShares ETF, and you can see that both of those give you entries. So just using this as an example, if we came across here, our entry would have been on Friday at around 136.20. So let's just say that we buy in on Friday at 136.20, and that's our entry point. Our stop, which is why I like this setup, is gives you a manageable risk parameter. We're going to use a stop right in here, which would be a shift back and a break back below. Let's just use 134 as our stop, and we've got a $2.20 risk margin against the 136.20 entry, which is about 1.5%. And you say, well, that's not very much leeway. Well, you're not looking for leeway. Either this breakout off of this temporary reversal is going to follow through to the upside, or it's going to fail. If it fails, you don't want to stay in the trade. You want out of the trade. This isn't a long-term. You're just looking for a short-term reversal trade. So we're going to use a fairly tight stop. So we got about a 1.5% risk relative to that. If we look at the total trade setup, the total trade setup comes off of a 127 bottom against a 136 breakout. So you got about 9 points on top of that, which would give you a target of 145 on the upside as your target benchmark relative to the trade. So you end up with a 9-point upside gain on the trade, and that would equate to roughly a 5% move on the transaction. So you end up with a roughly 3.2 to 1 risk-reward relationship relative to the entry of the trade, assuming that the trade works out to the upside. So today it starts to validate. And again, if this fails and comes back down, then we're out of the trade with a 1.5% loss, and we have a trade that is very manageable. And if this starts to move a little bit higher tomorrow on Tuesday, then we'll bring our stop up to break even. And so worst case is we get out of the stop at an even point as it moves up to the 145 target, and we just manage the trade out. The point for me is that when these mini reversals set up, they're going to set up one of two ways. They're going to set up like the S&P 500 did here, which is you got a couple, 3 chops to the downside and then a breakout of a bigger pattern. So you had many reversals within a pattern setup that confirms the breakout to the upside. So that's one way that it sets up. The other is to look at IWM, which is the Russell, which you can see relative to this that we set up very similar. We had come up to a resistance point here at 126.50. We come back and we test the downside, and you can see the resistance point off of this little mini bottom, and then we break back above the 123.75, which was the entry point for this trade. So this trade sets up a little bit more as a bottom reversal because it's set up more methodically relative to the way that this traditionally we would look at a reversal is for it to come down, it tests, and then it finds a way to recapture the previous trend. Now, the thing with the S&P 500 or the small cap Russell 2000 small cap index, it hasn't recaptured that trend line. It actually closed right on the previous trend line. So, but it's still a setup for a trade that's going to actually eclipse the old trend lines and reestablish the upside here to recapture that momentum back to the upside. That's what you're looking for in this particular trade. So your entry is 123.75. The break of this would be go back to roughly the midpoint there, which is going to be around 122.25 is what we will look at as our stop. So we got about $1.50 stop there, which is roughly the same. We'll go at 1.1, 1.2% risk on the trade. And then the target of this trade is going to be the height of the pullback. So we came back to 120 off of 127. That's 7. meaning that we would look for this to move back above the entry point or the previous high of roughly 7 points, or around 133.50 is what we look at as the target on this, which would be about a 10-point gain or about a 5% move. So you have the 3.5, 4-to-1 risk-reward relationship on the trade as it sets up. So you're looking for the trade in this situation is more of a traditional bottom reversal. So you had an event that caused the pullback, and the event in this situation was interest rates started to change. The dollar got a little bit weaker. So we had some fundamental economic data out there that was banging on the small caps, meaning that the belief forward was that growth was going to be at a discount. Therefore, small caps being growth-oriented discount the value. When that changes and the money starts to move back into growth, in other words, it invalidated the belief, and now it gives an opportunity to move back up. If it doesn't work out that way, worst case is we lose 1.2% on the trade relative to the entry. So you can see how each of these sets up just a little bit differently from the standpoint that with the S&P, we were looking at sharp reversals and then a breakout. An example of that would be right here on the small cap. You can see in this, we came up to this high, and then we got these sharp pullbacks within a range, and then it breaks from the range. So when the range breaks out, we take the entry, and the entry here was at 118.80 on the entry, and then your stop would have been back right in here around the 116.50-ish level. So 118.80 and 116.50 means that we had a $2.30, or again, about that 1 to 1.5% risk relationship. You had the height here of 114 to 118.50, 4.5 on top, takes us to 122.70 as the target. And so each step of the way, and your reward here on the upside, our risk of this was, so we're going to end up at about a $4 gain to about a $2.30 loss, and you can see your risk reward there is about 1.5 on that, and so it sets up a little bit differently, but you can see that this actually went right to the target, and then it reversed and tested again, rose, tested, rose, and then came back into this next reversal pattern. But you can see that this worked out extremely well on the upside and netted about a 2.5% gain. Now, you could also use TNA, which is the leverage 3 times on the S&P, which would have turned that into a 6 or 7% gain, but also leverages out the risk. You just have to weigh out how you want to trade it and how much risk you're willing to take on in that. So you can see within a chart that there's a lot of opportunities on these mini reversals, if you will. And the other thing is to always look for the pattern within the pattern, and that if you got here a head and shoulder setup with your neckline, and this right shoulder turned into this sharp consolidation range, that breakout negates this setup, which is even, so you get a little bit stronger signal by the fact that you're getting 2 things working at one time. And then, of course, you got volume, you've got other things that you could look at, MACD and other momentum indicators, but it gives you a confidence level going into the trade, seeing how the trade sets up relative to each of those events. XLK of late, which is the tech sector, and we had talked about this as an ABCD setup. I left this on the chart just so you could see that each of these are reversals within this channel. So you got a downtrending channel and you got a reversal, and then you get your breakouts in here that actually set up very nicely for an entry even before it broke out of the channel, out of this mini bottom. It gave you an opportunity to buy into that, and then you would have gotten stopped out here. But the point simply is that even within environments like this where it's kind of stepping lower, we had support come in right in here. So we got this ABCD setup, and then it starts to move, and then it kind of runs to the upside. So it sets up where you could have bought in here, or you could have bought back in here off the initial reversal. So either way that you want to set up the confidence of the trade. Lower profit with a longer-term confirmation, greater profit, but also greater risk relative to that. But let's also look at the fact that when we say greater risk, it's not necessarily that much greater. If we come across here, and there's our support, if we use this test back here and then this bounce, and we buy on right in here, which is right at around the 41.80 level, the previous lows back in here were right at the 41 level. So we had about a 2% risk on the downside, or about 80 cents. It's a little less than 2% risk, which to me isn't a huge risk factor when you're looking at both a pattern and a bottom reversal. And even if I wait till the breakout right in here around the $42 mark, my risk still back to the $41 mark is still about 2.5%. So I'm actually increasing my risk weighting relative to the stop on that, depending on how you would set up your stop. Or I would lessen my stop by the fact if it reversed back into the trend and breaks, then I'm out of the trade. But that would have taken me out of the trade right before it went higher. Whereas taking on a little bit more risk leaves me in the trade and lets it run higher. I'm going to always take a little bit more risk to give that test or pullback potential a little bit more room, especially when you consider the fact that we are on a sequence of lower highs. So you either have to give it enough room to test that and invalidate it, or in reverse, or you're going to get stopped out of the trade prematurely. So managing the stops obviously is another component of all of these. I'm just saying I would use the wider stops on all of these trades just because of how we've experienced them over time. So there's a couple that you see. Another one that happened today was the semiconductors. If we look at SOXX, and you can see within SOXX the same thing is that we had this test lower. We get a breakout off of another test lower right in here. It kind of fails, moves back, tests again, fails, and then now it's starting to break out. 95.50 was one entry point, or 96.50 was the other entry point, which is today's entry. 96.50 is the one that we dealt with today, and we'll look for that to run at least up to 99.50 or maybe beyond that on the upside. But you had another kind of a double bottom break and move on that. The 95.50 was the break of the double bottom, which if we look at that, you can see here's the first low, rises, comes down, and there's the second low, and there's the break above that was right at the 99 or 95.50 entry off of that mini double bottom breakout. And then if you waited for confirmation today, would have been 96.50, and then it moves back to the upside from there, and we'll see how far that moves. But you did have some nice moves within those today. One of the other setups that we saw on the day today was Skyworks, which is one we've been watching relative to these tests, and you can kind of see this descending triangle or wedge formation in here. And then today you get that break back above that with an entry right in here at the $99 level was the entry on that. You can see it closes at 103, and essentially you go into tomorrow with no risk by putting your stop at 99. You have no risk on that trade as it goes forward. Now, they don't always work that way, but that's a nice trade. But that was also part of the semiconductors, because we were watching semis coming into the day. We were looking at what semi setups were there to go with it, which is an important part, obviously, of anything that you're doing. Another one that we've been looking at is Regions Financial, and you can see this is the regional banks. I like regional banks. They've been kind of painful, but you can see that here you had a double bottom reversal, and then it came up. We got stopped out of this trade right here around $9.70. It came all the way down, retested the trade, came back into a resistance point right along here around the 945-ish range, and you can see that that bar right there broke above that. So we took the entry right there around $9.50. You can see that it just did nothing but trade sideways. We owned it at $9.50 with a $9.35 stop. So we had a 15 cents, so we get a $9.50 entry. We got a $9.35 stop. We got 15 cents exposure, or about 1.5%. And then we got this break above there, and then it's continued upward. Now, this bar right here on Friday was a concerning bar, but I thought it was more of a buy opportunity if it held this support right in here, which is exactly what it did, which was around the 992 level. It held that support, and if it followed through today, you could have added to that position on Regions Financial, which was what we did at $10 and some pennies this morning. And so we're still in that trade, and I'm still looking for this trade to at least go up to 1080, at least in the short term. And there's a couple of these that have set up. That's just one of them, KEY, which is Key Corp. You can see this break out of this range in here. Huntington Bank, HBAN, is another one that you see that's traded well within this range right in here. If we can get above this 1130 range, very nice breakout. But you can see these mini reversals have set up a couple times for opportunities within here at $11-ish to buy into Huntington Bank. Now, if we get above that 1130, then I think that what you're looking for is for this to actually move higher. And you can see the longer-term trend of that is to the upside, which is why I like the consolidation. If we can break above 1130, we go to a new high, and then we see how far it can go from there. STI, which is a little bit larger regional bank, SunTrust, but you can see a nice double bottom formation there. You got a trading range on top of that. But you can see within the regionals, there's been a lot of setups. I can do the same thing with the semis, which we just talked about. So to summarize, what you're looking for within these mini reversals are the opportunities that you can see as this one sets up. It's kind of a double bottom, breaks above that move there around 42.25. You got to stop back here around 40.65, and you just let it play out. Now, that one's still floundering, and if it can get above the 43 level, I think that becomes even a better trade on the upside. But you can see what you're looking for first and foremost is the test. I mean, these are essentially, people refer to this as a test of the trend line, and so you get a test as the setup. So once the test is there, then you look for it to establish a low. So you're going to look for it to establish a low point and bounce off of that low, and then you're going to look for a reasonable entry point off of that test of that low. And generally, it's going to come up, come back, and then it's going to create a opportunity. So you're looking for the test, you're looking for the bottom, and then you're looking for the breakout. So it's just a three-step process, is that you can see here's the test, here's the bounce, another test, bounce, couple more days of testing, and then it starts to set up where your entry point would be. And in this case, your entry point is going to be right in here around the 41.30-ish range, which you can buy on this bar or either of these bars, and you would stay in that trade until you got stopped out on that bar right there. And the same is true. Then it comes down, get a couple days bounce. You can see the clearer entry point at 41.20. And then you take that trade and you would get stopped out probably on this bar right here. And then you look for the next opportunity. Or you stay in them a little bit longer. It all depends on how quickly you want to trade in and out of a position, for one. And the choppier the position, the more quick I want to trade it. The more methodical the position, the more I'm willing to hold on to it. When you get into banks, you're more methodical. So I'm willing to give a little bit more volatility. When I'm trading, TNA, which is the 3 times leverage on the S&P 500 or on the Russell 2000, I'm going to trade a little bit quicker because of the risk parameters, which are really not as much risk as volatility, because the volatility swings are bigger because of the leverage. I'm going to deal with that a lot different. So you got to measure how to get into the trades, the entry, the exit, and the target, and then just manage it as you go along. Each step of the way is putting in the parameters that work for you. I'm giving you guidelines that work for me, and let's just go back to IWM as an example. When I look at this setup today, and I'm looking at this come break down, and then I'm looking right in here for my entry points. So this, anything that's going to clear above that line would be my entry. And you can see that you had a bar on last Thursday that gave you an entry point, Friday gave you an entry point, or today. So you can choose which of those bars. I would have taken the trade on Friday just because of the way it's set up, or on Thursday, I mean, and I would have taken that trade on Thursday. I would have held the trade with my stop back down here. So I'm going to take the trade at 123.25, roughly 120.50 is the setup on the trade, and there's my risk on that trade. Now today, with the move back up to 125.05, I'm going to bring my stop back up into this parameter around the 122.50, 122.40 range, and that lessens my risk on the entry down to 75 cents. And so you can see that all you're trying to do is measure, execute according to the measurement, but don't put yourself in a trade like this here and if you put your stop up here at 122.50, even though that's worked to this point, if you get one bar that looks like this on an intraday where it comes down and then it comes right back up, you're out of that trade because of the intraday washout. But if the stop's down here, you're still in that trade. You still stay there, and then you let it work itself out. Don't cut yourself short, especially in a choppy market where you got to give a little bit more leeway relative to that. So if the risk is too much, you just pass on the trade. In other words, if you're taking too much risk on the trade, to give yourself that leeway that the stock or the ETF will need, then don't take the trade. Move on down the road and do something else. There's plenty of setups in the market that you don't have to try to force one to work for you if the risk parameters don't work within your ideals. And you can see here SVXY, this is the VIX index, and you can see that we got into this choppy trading range in here, which is what the market, when we're talking about the S&P 500, you can see the resistance in here, but there's the 1, 2, 3 chops that we saw in the S&P. You see the same thing in the volatility index, and we got into that same trading range. Well, obviously it would be, because that's the VIX correlates to the S&P 500, so it's going to look like the S&P, or it should, if it correlates to it properly. And with the same thing, you get the SVXY breakout right in here around the 83.50-ish entry point right in here, and today we're trading at 87, so you get a 5% gain on the position, and now you can raise your stop up in here around the 84.50. You lock in a small profit and let the trade move as you go along, or you take some money off the table. If your target is hit on this, then you take a little bit off, take half off, take a third off, and let it work itself out, but manage the risk of that trade as you go along. So those are some trade setups that we saw, but they all go on the same parameters of a pullback test or a minor reversal, and then we look for the reversal back to the continuation of the trend. So with that, I hope that helps give you some ideas of how to trade some things within a choppy market, but also looking at how with a trend within a trend gives you opportunities as you go along for trade setups to maintain long-term positions as well as opportunities within them. So with that, I hope you have a great evening, and we'll see you soon.